Hello, I am Edmond Jamna, and on behalf of DW Consult, I want to introduce to you Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, and shaky base in accounting to an expert position and to a place of confidence. It is also a platform to stay abreast in all matters of accounting. Tutorials on the Go is also designed to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as any tertiary accounting discipline. All that is required of you is to subscribe to our channel on YouTube at DW Consult and click on the notification bell to be part of it. Also, like and share the videos by way of inviting others to come aboard. Tutorials on the Go, bringing accounting to heart. Now, today's episode's lecture, Doubtful Debt. In this episode, we will be discussing how to treat a debt in the financial statement in a situation where the receivable is believed to be unlikely to honor his or her debt. So we'll start with the definition of a doubtful debt. We'll look at the types of doubtful debt that we have. Move on to look at the steps of calculating the allowances for doubtful debt. We test our understanding and we look at the solution to the test of our understanding. Now to the definition. Doubtful debts are those that have some cause for concern about its settlement, but they are not yet definitely irrecoverable. Unlike the irrecoverable debt, the assessment for default here is not certain, but a likelihood, based on prevailing factors or historical experiences, such as a debt that has been outstanding for a while, but the customer is not responding to requests for payment, probably due to some financial difficulties, disputing an invoice or invoices, and/or is refusing to pay for bad service or defective products. Let's take a look at the accounting treatment. So an expense is recognized in the income statement in the name of irrecoverable debt, while an allowance for receivable is recognized in the balance sheet. The receivable account in the statement of financial position remains unaffected. Rather, the allowance for receivable is netted off it. The receivable balance must remain in the account in case the customer does pay up in future. So the treatment will be that we will debit the irrecoverable debt expense as said earlier. Then we will credit an allowance for receivables in the balance sheet. Now here, the movement in the allowance for receivables, that is increase or decrease, is what gets posted to the income statement account. We will understand it better when we test our understanding later in this lecture. Now, let's look at the types of allowance for doubtful debts that we have. The first we'll talk about is specific allowance. Here, a specific amount of receivables is known to be unlikely to be retrieved due to some prevailing conditions or factors, such as the customer experiencing financial challenges, but not yet bankrupt, disputing their invoice or invoices, or is refusing to pay for bad service or defective product, all of which may be resolved, hence they are not certainly irrecoverable. Therefore, an allowance to the specific amount in doubt is provided for. The second type of allowance is a general allowance. The business, per their past experience or practice, determines that it might not be able to retrieve wholly its debt. In addition, the likely irrecoverable amount cannot be specifically known. Therefore, an estimate of a percentage to the choice of the business of the outstanding receivable balance is provided for as an allowance. The specific allowance is applied first to the receivables, as we have just discussed. Then the general allowance is applied. Steps in calculating irrecoverable debt allowance. First, we'll write off the irrecoverable debt, as we have discussed in the earlier lecture. Then we adjust the receivable balance for the write-off. That is, we'll take the irrecoverable debt from the receivable balance at the start of the period. Now, we'll ascertain the specific allowance for receivables, if any. Then we move on to adjust the balance. Now, we'll now come and multiply the receivable balance above with a percentage or the chosen percentage for general allowance for the business. Now, after that is done, we have now gotten the allowance for general and specific. Now, what we'll do is that we'll add the specific and the general allowances, compare it to the opening balance for the period. Then the movement will go into the statement of profit or loss account. Now, net the sum of the allowances to the receivable account. Let's test our understanding. On 31st December 2010, Coded Enterprise had receivables of $10,000. Coded reviews and admits that he is unlikely to receive debt totaling $500. Now, from past experience, Coded estimated that the equivalent of 2% of their customers were likely never to pay their debt and therefore wish to make an allowance for this amount. During 2011, Coded made sales of $100,000 and received cash from his customers of $75,000. He still considered that 2% of the closing receivables may not be paid and should be allowed for. During 2012, Coded made sales of $120,000 and received $130,000 from his receivables, as well as 2% of his receivables should be allowed for. Calculate the allowance for receivables and irrecoverable debt expense, as well as the closing balances of receivables for each of the years 2010, 2011, and 2012. We'll start with the year 2010. So we'll open the accounts for irrecoverable debt account, allowance for receivables account, receivables account. Now one will ask, why is the irrecoverable debt account open here? Because as we said earlier, the movement and the allowance for receivables account will be recorded in the irrecoverable debt account in the income statement. Now let's take a look at the entries. Coded had a receivable balance of $10,000. So we come here and debit the receivables account for $10,000. Now we know that Coded reviewed his account and realized that $500 of his receivables are likely not to be paid. Now here is specific because Coded was able to determine that an amount, which is $500, will not be paid. So we come to the allowance for receivables account and credit it. We can go straight to the irrecoverable debt account and debit it. Now let's hold on for a while. We want to see the movements. Now 2% of the receivable balance is supposed to be catered for. Now this is a general allowance. We're just making a general provision for 2% of the receivable balance outstanding. Now, for us to be able to get a general balance, as we said earlier, we'll pick the receivable balance, which is $10,000. Then we will net an irrecoverable debt if there was, but we don't have any in this question. So it is 0. Then we'll less the specific allowance, which is $500 from it, before we multiply the 2% on the net. So we pick the $10,000, let's say by $500, which is the specific allowance, multiply by the 2%, it will give us $190. So we come to the allowance for receivable account, credit it $190. Now, we realize that the allowance for receivables has a 0 opening balance. There is an increase because the opening balance was a 0 and the closing balance was $690. So when there is an increase, we have to come to the irrecoverable debt account, debit it in the name of what? Allowances. Let's come on balance and close of the account. Let's start with the irrecoverable debt account. We draw total lines on both sides of the account. We put a 690 in the total lines because it's bigger. We come to the smaller side and find the balance, which is $690. Move it to the debit, which is the opposite side. Come to the allowance for receivables. Draw total lines on both sides of the account. Put a 690 in the total lines. Come to the debit, which is the smaller side. Find the balance, which is $690. Move it to the credit below the total line. Come to the receivables account. Draw total lines on both sides of the account. Obviously, put the $10,000 in the lines. Come to the credit side, which is the smaller. Put the balance there, which is $10,000. And move it to the debit side below the total line. We have an income statement account, which is the irrecoverable debt. So we have to come and close it off. We simply close it by crediting the account. Bring it to the statement of profit or loss account and drop it there with the name increase in allowance for receivables. Then we come to the statement of financial position. Then bring the receivables account balance there, which is $10,000. Then come and less it with the allowance for receivables, $690. Now, from the calculations that we did in 2010, we realized that allowance for receivable account had a balance of $690. So we carry it over here. The receivable account as well had a balance of $10,000. So we bring it to the debit as seen here. The irrecoverable debt account is an income statement, so it doesn't have to carry any balance forward. So the balance is 0. In the previous example, we realized that the allowance for receivable didn't have any opening balance. But now we have an opening balance. So we're going to see how the movement will come into play here. So Coded made sales in the year 2011 of $100,000. So what do? We come to the receivables account, debit it by $100,000. Then we would have credited the sales account if we were to show it here. He received $75,000 cash from the receivables. So we come to the receivables account. We credit it with cash, $75,000. Again, cash doesn't directly relate to the topic we are discussing, so we will not bring the cash account here. We were also told that he still estimates that 2% of the receivable balance will not be paid for. That is a general allowance. There is no specific allowance here. So what do? we have to just find the receivable balance and calculate 2% of it. Let's balance the receivable account for us to generate our general allowance. So we draw total lines on both sides of the receivable account. Put the bigger of the two sides, $110,000 for the debit, $75,000 for the credit. So we put the $110,000 in the total lines. Then we come to the smaller side, which is the credit, and find the balance. The balance will be $35,000 to the credit. We move it to the debit side and drop it below the total line. Okay, now that we've been able to find the balance, let's come to the calculation of the general allowance. So it will be the receivable allowance of $35,000 times 2%, giving us $700. It means that for the year 2011, the balance on the receivables account should be $700. But we already have an opening balance of $690. It means that there was a movement in the year of $10. Allowance for receivables is supposed to have a credit balance. So we put the balance on the debit side. We draw the total lines and put the $700 in the total lines. Now, there's a difference on the debit side. It cannot be a balance because the balance is already found here. So what accounted for the increase will be what? An irrecoverable debt of what? $10. That is what we are going to post to the irrecoverable debt account as an allowance to the debits. Let's come to the increase and see. There's an opening balance of $690, a closing of $700. So there's an increase of $10. Okay. So when we come to the statement of profit or loss or the income statement, we do an increase in allowance of $10. So the $700 is not posted to the income statement totally. It's only the increase. We come to the statement of financial position. We put the receivables balance, the $35,000. Then we less it with allowance for receivables. But here, the total balance on the receivables is less from the account, not the movement. Let's look at the final year, 2012. Again, there was a balance of $35,000 on the receivables account. It is carried over here. There was also a balance of $700 on the allowance for receivables account. So it is brought forward here. Let's look at the transactions that happened in 2012. There was a credit sales of $120,000. So we debit the receivables account. Again, credit the sales account, which is not shown here. There was also cash of $130,000 received. It is again mentioned that 2% of the balance should be catered for as a general allowance. So let's first close off the receivables account to get the balance. To draw total lines on both sides of the account. The debit is $155,000. The credit is $130,000. So obviously we put the $155,000 in the lines. Come to the credit side, find the balance, which is $25,000, and move it to the debits below the total line. Now that we have found the balance, we come to the general allowance. So once there's no recoverable and there's no specific, we just pick the $25,000 and find 2% of it, which will give us $500. The year 2012, the allowance for receivable should be $500. So the opening balance in the allowance account was $700. So there has been a decrease in the allowance account of $200. Now, all know that the balance has to be what? Finally end up on the credit side. So we bring the balance to the debit side and put it there as $500. Now, we draw total lines on both sides of the account. Then we put the bigger of the two, which is the $700 there, right? Ideally, we should have ended up with the balance, but now we are started with the balance. That's how the allowances work. Now, the difference will be on the debits. So we put the $200 there as a recoverable. Then we send it to the income statement. Because it is a decrease, it will not be on the debit side. It will come to the credit side. So when we come to the income statement, we put income there. Then we put decrease in allowance for receivables as $200. We now come to the financial position. Then bring the receivables balance, $25,000 there. Then we come and less it with the balance. I hope you have understood our discussion on doubtful debts. If you have any queries, kindly drop them in the comment section below. You can also do so via our social media handles, DW Consult. We'll also entreat you to click on the subscribe button below and click on the notification bell as well. Stay blessed. Poker.